If you're holding cash for a future home deposit or just waiting on the sidelines for the right time to invest, this episode could stop you from missing out on tens of thousands of dollars in lost income. Because right now, while you're earning 4% in a savings account, Chris Joye is helping his investors earn more than 7% from the very same banks you're borrowing from.
One of the bridging opportunities that sits between cash and equities is obviously bonds. Bank bonds today are paying interest rates between 4.5% and 5%. On bank bonds, whether you're earning 4.5%, 5%, 5.5% or 6%, bonds are going to generally beat deposits.
We bring back one of Australia's most respected bond experts, Chris Joye, Chief Investment Officer of Coolabah Capital, who manages over $15 billion in assets. He breaks down how doctors and high-income professionals can move beyond the old-school cash versus ETF versus property mindset and start using fixed income as a fourth option. In this episode, you'll learn how US Treasury bonds affect the global economy, how bonds affect the property market, and where a seasoned bond trader sees the global economy heading in the next couple of years.
The bond market and the US Treasury market is really signaling where interest rates are going in the future. So the whole world is very, very focused on interest rates.
So if you've got $500,000 sitting in an offset, or you're just sick of earning less than inflation, this is the episode you need to hear. Lastly, remember, everything discussed in this episode is general information only and should not be taken as personal financial advice. Speak to your professional or financial advisor before making any decisions. Hi everyone, welcome back to another installment of the Investing for Doctors podcast. I've got Chris Joye back with us today. Welcome back, Chris.
Thank you for having me.
All right. Now, give us the 30-second sort of introduction to yourself.
I started off at Goldman Sachs, worked for the RBA, studied for a PhD at Cambridge University, set up a fixed income investment business, sold that to Macquarie Bank in 2010, set up Coolabah Capital Investments in 2011. We run about $15.5 billion in bonds. We have 5 ETF products, and we're the most active trader of Aussie bonds in the world. And we buy and sell about $500 million to $1 billion a day. And we also have the biggest team in the market. So I have 54 people in the team, 12 traders, and 21 analysts.
Yeah, welcome back. And today we're going to talk about, a bit of politics, a bit of topical subjects, and maybe a couple of scenarios on, what you would do if you were in my shoes. Okay, so let's. I think one of the things that a lot of people talk about is U.S. Treasuries, and that seems to be the topic every time you open a newspaper. It's about Treasury and how the U.S. bond market is affecting overall, the overall economy in every country around the world, basically. So, first of all, I mean, what is a U.S. Treasury, and what do they actually do, and how does that relate to bonds?
Yeah, so a Treasury is just a U.S. government bond, and that means it's U.S. government debt. So when Trump spends money, and right now he's spending more than he's getting via taxes, he has a budget deficit, and that deficit needs to be funded. So to fund it, they need to borrow. And to borrow, they issue debt, a treasury. Yeah. So it's just a debt security. And it's no different to you buying a home and saying to CBA, I need a loan. 70% loan. CBA gives you a mortgage, but really that's basically you borrowing money, and you're technically if you're a trader or a financial markets guy, you're issuing debt to CBA. Yeah. You're issuing a bond to CBA, which is your mortgage, and you pay CBA 6% on that. Yeah. Now, when the US government borrows right now, if it's borrowing money for a 10-year term, it's paying about just under 4.5%. Yeah, that's their interest rate. So think about that. If you're Trump, you really want to keep that yield, your cost of debt, your interest rate as low as possible.
Yeah, because the government has to pay that off in tax receipts.
So a big focus for Trump is trying to talk down interest rates. Yeah, he's trying to get the Fed to cut its interest rate. Now, the Fed rate is the cash rate. That's the overnight borrowing rate. The 10-year Treasury yield is the 10-year US government bond yield. And that's the interest rate that the US government pays investors like me when it borrows money for 10 years. And then the 5-year yield is the interest rate on the 5-year bond.
Yep.
The 3-year yield, 3-year bond, and so on. Now, the US Treasury yield curve is just the line that you would draw from the overnight cash rate.
Yep.
That's controlled by the Fed. And currently that's actually a range. So the cash rate is 4.25% to 4.5%.
All right. Okay.
All the way through to the US 10-year yield, which has been as high as 4.8% this year, but is right now just below 4.5%.
Okay.
Now, the direction of that yield curve gives us an insight on where the Fed's going to take interest rates in the future. So really, the 5-year yield on a US Treasury, very simply put, is where financial markets reckon the average Fed cash rate will be over the next 5 years.
Yeah.
So if you look at Australia, the RBA cash rate is 3.85%. The 10-year government bond yield in Australia is about 4.3%. So that curve is sloping up. But if you took a 5-year Aussie government bond yield, that would be basically the market's guess of where the average RBA cash rate will be on the next 5 years or over the next 5 years. So let's just say that everyone's really worried about inflation. They're not so worried about inflation right now, but if we were really worried about inflation, people might say over the next 5 years, the RBA may lift its cash rate from 3.85 all the way to, say, 6%, right? And potentially the average interest rate over that period might be, say, 4.5% to 5%.
Yeah.
So the 5-year government bond yield might be 4.5% to 5%. So the bond market and the US Treasury market is really signaling where interest rates are going in the future. And that's why it's so topical.
Yes,
the reason everyone talks about US Treasuries is because it's signaling the direction of US interest rates. That means it's telling us what borrowing costs will be over time, and borrowing costs determine asset prices. We all know that if the RBA cuts the cash rate, what happens to house prices?
That goes up.
They go up. Conversely, if the RBA lifts the cash rate, what happens to house prices? They go down.
Yep.
And the same is true of stocks. If the Fed aggressively lifts interest rates, US stocks go down, and vice versa. So the whole world is very, very focused on interest rates. And it's the barbecue stopper. We all talk about it. And the barbecue stopper in the United States is the Treasury yield. And in particular, because most US home loans are not variable rate loans.
They're different from us.
They're not floating rate loans. No, they're more than 80% of US home loans are actually priced off 10, 15, and 30-year US Treasury yields. So the barbecue stopper in the US is actually the US 10-year government bond yield. In Australia, it's the RBA cash rate. Why? Because 80% of Aussie home loans are variable rate, and they don't price off the 10-year government bond yield. A variable rate loan prices off the RBA cash rate, which is the overnight cash rate. If the RBA lifts rates, our home loan rate goes up and down, in the alternative scenario.
Yeah, that's a very interesting point because I've also listened to US sort of podcasts and also watched some of the videos. The property market in the US is very different from Australia. And why is it in the US, home loans are usually fixed and over a long period of time, whereas in Australia, fixed loans, I think the maximum they go up to is like between 3 to 5 years. Why is that?
Yeah, it's really a function of the fact that there is a very active 30-year government bond market in the US.
Yes.
And there is no active 30-year government bond market in Australia. The reason there's an active 30-year government bond market in the US is because the US created 2 government-owned entities to back and issue 30-year bonds, and they're called Freddie Mac and Fannie Mae. And basically, they issue AAA-rated bonds that are regarded as being government guaranteed that have a 30-year yield on them. And that's created a benchmark for long-term debt issuance that we just don't have here in Australia.
Yeah.
And what that means is the average maturity of a debt issue can be much longer in the US because you've got an active market where investors will buy bonds that are longer dated.
Yeah.
Here in Australia, up until very recently, it was extremely rare to see a bond issued with more than a 5-year maturity. In the same way, it's very, very rare to get a fixed rate home loan of more than 5 years.
What? Yeah.
Now, your home loans are all 30-year mortgages, but the interest rate risk or interest rate profile is one of two things. It's variable rate, in which case it's effectively priced off the RBA overnight cash rate. It could change any day. The RBA could have an emergency meeting tomorrow and cut rates, in which case your home loan rate would fall immediately. Alternatively, you can get 1 year fixed, 3 year fixed, 5 year fixed. But typically the maximum fixed rate term is 5 years.
Yeah, I've not seen more than 5 years.
And that's because banks can't borrow normally for much longer than 5 years.
Yeah, I see.
So if you can't borrow for more than 5 years, how can you lend for more than 5 years if you're CBA, right? So if CBA could borrow 30-year money, they could lend 30-year money at a fixed rate of interest.
Yeah.
In the US, it's much easier for banks to issue long-dated debt and borrow money and therefore lend on a long-dated basis. And it's a little bit more complicated than that. There's something called the securitization market, and Fannie and Freddie support that. And basically they allow lenders to borrow lots of long-term 30-year paper or money, I should say, and therefore lend on a long-term 30-year basis.
Yeah, I guess the simplified version of that is because their money markets can allow them to do that, whereas ours don't.
Yeah, and even, I'd put it as our banks can't fund themselves on those 30-year bases.
Yeah, because they can't match the risk.
They can't match the risk, whereas in the US you can.
Yeah.
But all of that means is that the barbecue stopper for home loan borrowers in the US is the long-term treasury yield. Here in Australia, it's the RBA cash rate.
Yeah, that's I guess that's just a function of the different financial system and a money market.
Yeah, it's really a function of government. You know, government in the US have decided to commit to supporting funding for 10, 20, 30-year terms, whereas Australia's not done that.
Yeah, I see. Now, the controversial thing is we're now becoming an increasingly multipolar world. I think that's a topic that comes up every now and then because the US debt issue is becoming a bigger and bigger problem. What do you see as a bond trader on the US being downgraded by Moody, which is the last remaining credit agency to downgrade the US dollar? Yeah,
so Moody's downgraded the credit rating on US government bonds to a level that was the same as Standard & Poor's. Standard & Poor's downgraded them years ago. But I think your question is, the US government is borrowing a lot of money. It's issuing a ton of debt. It's running big budget deficits. What does this mean for the world? What does it mean for interest rates and bond investors? So the bond market's very focused on how much the US government's borrowing, because all things being equal, more debt issuance means higher interest rates or higher yields. And it's no different if you think about a property developer. One way of sort of framing this up would be to say, if you've got a Meriton and they have to sell a truckload of apartments, they're going to have to lower their prices. And what does lower prices mean? Better rental yields. If you're buying the apartment cheaper, you're going to be able to rent it out for the same price. And that means you get a higher yield. In the bond market, it's exactly the same. So, if Trump wants to spend a lot of money, or if the Victorian government or the New South Wales government or the Aussie government want to spend a lot of money, which they all do, they're all running huge deficits. That means yields go up. And all things being equal, for bond investors, that's great, because higher yields mean higher returns. Now, as we discussed, if you've got a floating rate note and the RBA cash rate goes up, you're fine, your yield goes up, your price doesn't change. If you own a fixed rate bond and the RBA cash rate goes up, your price goes down, so you're not so happy. So if you're a current fixed income investor and you own fixed rate rather than floating rate notes, and yields go up, that could be bad. For the floating rate investors, it could be good. So it does depend on what your portfolio position is when yields change. But as a generalization, high yields are good for fixed income investors. And the talk around bond markets is really that nexus between yields, budget deficits, how much politicians are spending, and ultimately, what does that mean for punters, and particularly home loan rates. So in the US, more spending means higher yields, which means higher mortgage rates, which is bad for US housing.
Yes.
Because remember, we discussed most US borrowers are not floating rate, they're fixed rates. More than 80% of fixed rate. In Australia, it's a little bit different. In Australia, we're much more focused on the RBA cash rate. And now the nexus with the RBA cash rate is kind of interesting. So, Victoria, New South Wales, Queensland spending crazy amounts of money. and they're borrowing heaps. They're issuing a ton of debt. So in 2019, before the pandemic, Victoria owed the world about 50 billion. Within a few years, they're going to owe the world close to 300 billion. They're actually borrowing 30 to 40 billion a year now.
Wow.
Right.
Okay.
Having owed a totality of 50 billion back in 2019, only a few years ago. So what a lot of government spending can do is create inflation. And inflation could force the RBA to lift rates. Now, right now, the RBA is not worried about inflation. Right now, rates are going to head a bit lower. The market is 98% price for an August rate cut from the RBA. They've already cut rates in February and May as we expected. We thought they'd cut rates in July, but they paused because they want to see the inflation data at the end of July.
Yes.
But the market's right now pricing an RBA cash rate by the end of this year of 3.25%. So that basically means we're going to get about 60 basis points of cuts. What that means is more than 2 standard RBA rate cuts, which are typically 25 basis points a pop. And that'll be positive for house, very positive for property, very positive for house prices.
And similarly, that's also good for asset prices, like stocks and that sort of prices as well, I guess.
Well, if the RBA cuts the cash rate, that would be good for asset prices. And if the Fed cuts its cash rate, that would be positive. Trump's putting Powell under a lot of pressure to cut rates. Powell, at this point, hasn't cut rates. He was very, very keen to cut rates when there was a Democrat in power in the White House. So Powell was a bit political. Last year, he was doing everything possible to help that Biden-Harris sort of victory along. But as soon as Trump was elected, he has a pretty toxic relationship with Trump, and he sort of said, like, we're not cutting rates. I mean, he cut in December, but he hasn't cut since. And they probably should cut rates in the US a little bit because inflation's actually been pretty benign in the US. So that would be positive for stocks. And stocks are at an all-time high, partly because the stock market is now less concerned about the trade war, less concerned about inflation. It does look like Trump's doing some pretty good trade deals. He's done a deal with Japan that the market loved at 15% tariff, less than was expected. There's talk of a 15% tariff with the EU, which would be very positive. He's done a rare earths deal with China, and he's doing deals left, right, and center, including, a beef deal here in Australia.
Yeah.
So the market is becoming more constructive on the trade war.
I find that very interesting because a lot of the crisis was created by him in the first place.
Which crisis?
The trade war crisis. It was like Trump creates the crisis and then he solves the crisis and everyone's happy all of a sudden.
Yeah, it is interesting. I mean, I think his approach with the benefit of hindsight has been potentially good in the sense that he went in super hard on the 2nd of April, so-called Liberation Day, with these very, very hefty tariffs. He kind of doubled down on the 9th of April initially, but then halfway through that day, he kind of did a bit of a backflip and he said, actually, I'm going to give the whole world except for China 3 months to do deals with me. And then I'm going to lift Chinese tariffs. That's what he announced on the 9th of April. And then thereafter, he said, actually, we're going to drop Chinese tariffs and do a deal with China. And he has been able to do deals whilst keeping tariffs, albeit lower tariffs in place. And the tariffs are generating a lot of revenue for the United States government. But the incidence of the tariffs are ultimately going to be paid for by
Americans.
Most of, on our numbers, in the case of China, it looks like the Chinese are paying for about 20% of the tariffs, and US consumers and businesses are paying for about 80% of them.
Wow. Okay.
But at the margin, the purpose of the tariffs is not to raise money per se, but it's actually to try and incent US businesses to bring their manufacturing home. And Trump wants a manufacturing investment boom. I think he will get one. He's been quite successful in encouraging global businesses to build manufacturing in the US, and he wants to reshore those strategically important supply chains and then in turn create a huge capex boom, which I think is what we're going to get in the US. So I'm actually quite constructive of the US economy.
Okay. And I mean, it's interesting that he wants to do that, but the US is not very competitive on pricing in terms of its labor market. So I guess a lot of this capital that's coming in is going to be automation driven because they haven't got enough engineers, they haven't got enough skilled workers to do what they want to do in a knowledge-based economy because that's all offshore to China, India, and
well, they're still the R&D engine of the world,
of course,
but you're 100% right. I mean, it's only possible in a automated, digitized, AI factory world. And what Tesla has proven and SpaceX have proven is 100% you can build cars and satellites in the US, as long as you automate your processes.
The majority of it,
Yeah, and in 2025, that's possible. With digital printing, digitization. You look at companies like Anduril, the defense disruptor. They've been immensely successful building very, very complex defense product in the US. SpaceX has a monopoly on the global satellite business until the advent of BYD. Tesla was globally dominant in EV. So I think they can actually produce a lot of stuff for the US. It doesn't necessarily mean it'll be the cheapest, but I do think you'll see a manufacturing investment boom in the US, because I think what the US will do is force producers to manufacture strategically important products in the United States. They don't want the Chinese making, for example, their telecommunications kit.
Yeah. I mean, well, but at the same time, one could argue, there's 300 million plus people in America. The world's a lot bigger than that, and maybe some people just forego that market.
100%, yeah. So many exporters in China will just pivot away to different markets, to Europe, to Australia, to New Zealand. And so this is the paradox of the trade war. For the US, it means higher inflation temporarily as those tariffs pass through like a pig through a python, the trade data. But in Australia, our modeling suggests it's actually disinflationary, because the Chinese dump their cheap goods like BYD cars, which are outselling Tesla's 3-1 here in Australia, onto Australia. So we kind of perversely benefit from the trade war, in the sense that we get lower consumer prices. Or put differently, consumer prices do not increase as fast as they otherwise would, because the cheap exports, the dumping of cheap goods that China and its proxies can't sell as effectively into the US market, that gets diverted to Australia.
Yeah, that's a very interesting take. I mean, some of the I drive a BYD. It's quite good. But and somehow it's benefiting Australia in a way, because the exporters from China are no longer focusing on the US; they're focusing on the other countries, and that has a bit of a deflationary.
Well, it is interesting. Like the impact on Chinese prices into the US is actually, on our modeling, pretty small. So the tariffs thus far, the totality of the tariffs should have increased China prices into the US by about 8 percentage points. But because they've absorbed a chunk of that, because they've absorbed a chunk of that, the actual price impact thus far, I think we've estimated, is around 6 percentage points. So you're talking about it's non-trivial, but it's only a 6% increase in prices. It's not as bad as it might have ostensibly seemed. So I think you'll still see China selling a lot of stuff into the US, but you will also see some changes, I think, in consumption patterns, some shifts to domestically produced goods. And I think in key industries like NVIDIA chips and other strategically important sectors, China's going to be blocked completely.
Yeah. Oh, that's very interesting. And so another trend that I'm sort of hearing about is that this concept of de-dollarisation. I think it's probably not going to happen anytime soon, but BRICS is starting to trade amongst themselves in their respective currencies rather than buy everything of the US dollars. The Saudis are now selling oil in their respective countries' native currency. What do you think what sort of impact do you see on the US side of things? I mean, is that going to again increase their interest rate that the Treasury has to pay?
So I think some diversification out of the US probably actually makes general sense, because the world's based on all the available data, the world is massively long the US and overweight the US. So they're actually more exposed to the US than they should be on a first principles basis. If you're just building a fresh portfolio and you're looking at, for example, market capitalization weights, I think most investors are overexposed to the US. Having said that, like, the US is going to remain the innovation and entrepreneurship engine of the world. I don't think that's going to change. I think what Trump's doing is going to precipitate a manufacturing investment boom that will be actually really positive for the US. So I'm not a big buyer of the idea, and there's no evidence to suggest that there's a material shift out of the US. So let's just deal with the first point. There's no really convincing data to persuasively make the case that the world is diversifying away from the US, even though there's arguments in favor of that if you just wanted to go back to a more equilibrium portfolio construction posture. I think diversifying out of US, so one consideration is US assets. Another consideration is foreign exchange reserves. It doesn't make sense for central banks around the world to diversify out of US dollars. Well, certainly if you're a non-democratic state, I think that makes a lot of sense, because the Russians discovered when they invaded Ukraine, they had all their US dollars frozen. They now can't access those.
Yeah.
So if you're a non-democratic country that has US dollars, 100% you should be selling your US dollars. At the margin, you probably got some crypto diversification as well.
Yeah.
Not necessarily amongst central banks, but I think just in terms of FX holdings. And in terms of the treasury market, one thing you were intimating to, could it be the case that people are selling vast swathes of US government bonds, like the Chinese could be selling US government bonds? Is that pushing up yields? I suspect there has been within the US Treasury market big compositional shifts. So it wouldn't surprise me at all if the Chinese were selling US Treasuries.
They are, yeah.
Yeah. But at the margin, there's almost infinite demand for US Treasuries at the right interest rate, and yields on US Treasuries are pretty attractive, as we discussed. Like they've been around 4.5%, and there's no shortage of marginal buyers. So I don't think the Chinese selling is necessarily putting upward pressure on yields, and I don't think it's a big deal. If they were to exit the Treasury market altogether, I think there's ample prospective buyers.
But the trend is there, and so what happens when the U.S. is in so much debt that they are starting to not be able to repay it effectively. I guess the tariffs are raising some revenue for the country, but I think I saw one statistics that their annual repayment is already greater than the defense spending.
Yeah. So your question is there a potential credit crisis that could loom in wait for the US? And US government debt to GDP last year was 98%. There are some forecasts that suggest it could increase materially to north of 130%. The challenge is they're running a budget deficit of around US $2 trillion a year. And then Trump's tax cuts are going to cost 8.1 trillion US. So he's got an existing deficit he needs to fund of $2 trillion a year, and his tax cuts are going to cost another 8.1 trillion. That's over 10 years. Now the tariffs on all publicly available estimates raise, even assuming some substitution away from goods that have attracted high tariffs, the tariffs look like they're going to raise somewhere between 2 and 3 trillion US. So let's say that rather than funding 8 trillion, he has to fund, say, something in the order of 5 trillion. Right?
Yeah, over 10 years.
Over 10 years. Now, the Doge initiative run by Musk, which is still afoot, has actually been, notwithstanding some of the vilification of Musk, has actually been pretty successful. So they've already found 200 billion a year of savings in the short period that Doge initiative has been afoot. And Musk's target was to basically find about $1 trillion a year of savings. So $1 trillion a year of savings. So there's basically cut the budget deficit in half. So the budget deficit, if it went from $2 trillion to $1 trillion, $1 trillion a year over 10 years would more than pay for all the tax cuts. That requires reducing the US budget deficit by $1 trillion a year, or cutting in half, requires a 15% reduction in government spending. And a 15% reduction in US government spending is superficially a fairly achievable task, you would think, given the bloated nature of government. Here in Australia, we've seen an explosion in government spending. Government has driven most economic growth in Australia since the pandemic. Government has accounted for most jobs growth. There was an article in the Financial Review this week that suggested that, amazingly, half of all of Australians get most of their income from the government. You look at the NDIS, we're talking about the interest bill on US debt being more than US defence spending. Well, the NDIS alone is bigger than the Aussie defence budget, which is remarkable, and it's coming up to the size of Medicare.
It's bigger than Medicare already.
Yeah. And so this pork barreling by politicians who preternaturally want to spend money to buy votes, spend money on the people in the present by borrowing it from voters in the future, which they don't have to obviously contend with in the present, is really interesting. So at some point, the music has to stop, in the sense that at some point, all this spending, the risk creates inflation again.
Yep.
That pushes up interest rates. As interest rates go up, the cost of debt goes up. The cost of debt becomes so all-consuming. So I think, in the case of, say, Victoria, as I mentioned, pre-pandemic, they owe the world $50 billion today, or in a few years they'll owe close to $300 billion. The interest bill on Victorian government debt could rise to $15 to $20 billion a year, and you're talking about 3 to 4 hospitals of interest cost a year in terms of what it would cost to build a new, large major public hospital. So these debt bills are becoming massive. Again, what does it mean for markets? In the short term in Australia, what's interesting, if you think about the macro climate, we've actually got inflation that's been declining. So consumer prices are rising, but at a slower rate. Inflation's moved into the RBA target band, which is an inflation rate of 2 to 3% a year. And the RBA is cutting rates. We've had 2 rate cuts, likely a third in August. So the risk, in Australia, not the risk, but the dynamic in Australia is we've got very strong population growth driven by immigration. And population growth is very strong for economic growth.
Yes.
So that's positive. You got a hell of a lot of state government spending, a hell of a lot of federal government spending. So that's positive growth. And then you've got interest rates falling and house prices starting to rise very sharply again in Sydney and Melbourne. So, when the RBA cut rates in February, if you look at the CoreLogic house price indices, I was a co-inventor of the pattern for the hedonic compositionally adjusted daily CoreLogic house price indices, which were the first of their kind anywhere in the world. But if you look at those indices, house prices in Sydney and Melbourne were falling in 2024, and they stopped falling the same week the RBA first cut rates in February, and then they started rising again. And when they cut rates in May for a second time, they started rising more quickly. If they cut rates in August, we're going to get a bit of a mini house price boom, which is obviously positive for property. So in the short term, there's nothing really to be negative about in Australia from a macro perspective. And in the short term, I'm actually pretty positive, on the US economy. Actually, over the next few years. The risk in the medium term is productivity. Aussie productivity is pretty much the lowest amongst our developed peers, and is kind of at a multi-decade low if you look at labour productivity, but also what we call multi-factor productivity, which is all forms of productivity. And it's mainly because Aussie businesses don't spend nearly as much money on software and technology, on becoming more efficient. And it's also mainly because the public sector has become such a large part of the Aussie economy, and the public sector is super inefficient compared to the private sector. So in the long run, I've argued Australia risks becoming Asia's Ibiza, like a beach resort for the rich members of the Indo-Pacific region. And because we don't really make much in Australia anymore, we're kind of, we're trading on tourism and commodities exports, and kind of trading on borrowing from the future to spend in the present.
Yeah, I mean, we're a primary producer and we're services. There's nothing in the middle. And we're not really taxing much from our primary resources anyway.
Correct. Yeah, exactly.
We're digging stuff up and shipping it overseas, but the country doesn't get anything from it. I mean, I'm not worried about the short term. I'm worried about the medium term for my kids.
100%.
And, the future generation and what that means for Australia as a whole. At some stage, they have to. We have to be faced with some serious pains because, as you said, the public sector is paying for a lot of these things. When does it stop?
Well, at some point, taxes have to rise a lot further.
Or
we grow ourselves out of the problems, but the growth will be hard to come by if you're not making much.
Exactly. Because I think the last data I've seen is that we've had 8 quarters of per capita GDP.
Yeah, correct. Recession.
I think there was one quarter where it just tipped above zero, but the overall trend is that, as you said, productivity is.
What it means is Australia's, on a per capita basis, we're actually seeing a reduction in living standards.
Absolutely, and I think that's quite felt across the country. And so,
but the problem, of course, is if it's true that more than half of Australians are getting the majority of their income from the government sector, it's very, very hard to pull back on that government spending.
Because
who's going to vote for that?
Nobody's going to vote for that. And herein lies the problem, right?
It's the Dan Andrews playbook, right? To spend like a drunken sailor and conflict the entire voting electorate. and get everyone on the public purse, and they keep voting for you. And that's what happens in Victoria. They keep voting Labor.
But at some stage the music stops, and who's gonna be that one person holding the? Yeah, I think it's a very difficult thing to think about, but I suspect in the short term, as you said, everything's going to be hunky-dory. As long as you have assets, people who don't have assets, they're going to get stuffed in.
Correct.
Yeah. And so I guess it's if you can get into the market, no matter what it is. Now, as the last part of this podcast, I'm going to ask you a couple of questions, because these are things that our sort of viewers will probably typically face, and they ask a lot of these questions, and I think you'll be able to answer and help some of these guys out. One of the most common thing that we get asked in our group is that, hey, I've got say $500,000 sitting in a high interest savings account, and but I need that money in a year, 2 years, 3 years to buy my home as a deposit or whatever. What do I do with that money in the meantime? Because I think typically people just been putting it in the bank, saving up, getting some interest on it. But as interest rates come down, that's a terrible place to be putting money in.
Yeah. So, I think obviously I can't give anyone personal financial advice, but if I was thinking about myself, on the one hand, house prices rising at a 7% to 8% annual rate in Sydney and Melbourne. But on the other hand, right now the RBA cash rate is 3.85%, and you're lucky to get above, much above 4% on a savings account or a term deposit. And as you said, those rates are going to come down, and house prices are only going to accelerate further. You can punt it on the equity market, but that's a bit of a gamble.
It's risky.
We saw that US equities fell 27% between February and April. So you could torch a third of your capital really quickly if there's volatility in the equity market. And I think what we've discussed on the previous podcast and a little bit today is one of the bridging opportunities that sits between cash and equities is obviously bonds. So CBA funds itself 90% via debt, 10% via equity. In the same way, if you buy a house, the buyer has a 10% deposit, that's their equity, and he borrows 90% from the bank. Well, CBA is borrowing 90% of its money from the world. A big chunk of that comes from deposits. So when you put money into a bank deposit, you get 4%. You're lending money to the bank, and that's the interest rate the bank pays you back in return. But another big chunk comes from CBA bonds, and that's what retail investors don't necessarily have direct access to. It's very hard to have a direct investment in a bond because the minimum increment is $500,000, and it's generally a wholesale market. Now, bank bonds today are paying interest rates of, if you're investing in a senior ranking bank bond, you might see somewhere between 4.5% and 5% from the major and regional banks. And if you're investing in a subordinated bank bond, you'll see interest rates of between 5.25% all the way through to close to 6%. And then you can step down further in the capital stack above equities and below subordinated bonds. You have bank hybrids. Now the hybrid market is phasing out. The regulator of the banks has said it doesn't want banks to issue any more hybrids, so they're disappearing, and the interest rates are not as attractive as they used to be because people have effectively bid up the price and reduced the yield. But on hybrids, you're probably getting 5.5% to 6%. So on bank bonds, whether you're earning 4.5%, 5%, 5.5%, or 6%, bonds are going to generally beat deposits. So that's one opportunity. And that closes the gap between what you're getting on your savings account, say circa 4.5%, and what the capital growth rate might be in the housing market at circa 7 to 8%. Now, the other beauty of bonds is those yields are better than what you're getting in investment properties. If you're buying, we just spoke earlier to the head of research at CoreLogic, Tim Lawless, and he said to us that if you're buying a house in Sydney, you're getting a rental yield of about 3%, even less. That's before transaction costs and holding costs. And if you're buying an apartment in Sydney, you're getting about 4%, maybe close to 5% in Melbourne. So the interest rates on subordinated bank bonds at 5 to 6% basically beat property yields generally. That's the first point. At Coolabah, we also offer unique leveraged bank bond portfolios, which are available as ETFs And so we run the Global Floating Rate High Yield Fund, and the Global Floating Rate High Yield Fund trades under the ETF ticker YLDX, and YLDX offers a leveraged bank bond yield of 7.1% per annum, and that's a cash yield. There's no franking credits; it's a real yield. And that's a portfolio that's A+ rated. It's daily liquid. Its biggest exposure is to the four major banks: ANZ, NAB, Westpac, and CBA. And 70% of YLDX is senior ranking bank bonds, and 30% is subordinated bank bonds. Currently has no hybrids. And so that's an innovative way to boost your yield. Yes, there is leverage, which can amplify risks, but the portfolio is daily liquidity. It pays monthly distributions. It's A+ rated, and your risk is that the banks default on their bonds. And the major banks have never done that. In the last century or two in Australia, banks defaulting on deposits or bonds has been extraordinarily rare. So floating rate high yield, or YLDX, I think is a really interesting income generating solution. It's an alternative to hybrids. You get a better credit rating than the hybrids because major bank hybrids are rated in the BBB band, whereas we're producing a portfolio that's rated A+. It's had a superior return to hybrids in the last 12 months. It's got a better yield than hybrids. It's got better liquidity in the hybrid market, but it is leveraged senior bonds and subordinated bonds, whereas hybrids are unleveraged, albeit that they sit below subordinated bonds in the capital structure, which means they're actually structurally levered exposure relative to sub debt and senior. So it's slightly nuanced. But the best thing you can do is speak to a financial advisor or read the product disclosure statement, understand all the risks, understand that past performance is no guide to future returns, all the usual caveats.
The other usual, we will say that again at the end of the show.
Of course, but I think diversification and moving away from that bipolar portfolio of cash and equities, or cash, equities and property, and throwing in some attractive interest rates via bonds, particularly if you can get 7 to 8% yields. We also are the most active trader of bonds in the Aussie market. And when we trade bonds, we look for bonds paying a bit of extra interest in the same way that if you have a term deposit book or portfolio, you might roll from Westpac to Rabo, or from ING to Macquarie, or from CBA to ING to get a better TD rate. What we do is we actively trade the bonds to get better yields or interest rates, and we're looking for the CBA bond that's paying a higher yield than the ANZ bond, and we're switching from one to the other. And that way we can actually boost the overall portfolio return to a level that's actually better than the yield. So we've generally always done that. We've generally year on year produce returns that have beaten the interest rate on the bonds, because by trading the bonds we get a bit of capital gain when we find a cheap bond paying too much interest and the interest rate drops down to a target, and we get some price appreciation, and that profit allows us to supplement the yield in the same way that you might buy an apartment yielding 4% and hope you get a bit of capital gain or capital growth on the apartment. And so your total return is the yield on the apartment plus the capital gain. We're doing the same thing in the bond market.
Or you're doing like intraday trading for stock in the stock market.
Correct.
You're always beating it, for instance. And you get that extra gain at the top.
Difference is in the stock market, most people don't beat it. Whereas when we trade bonds, we make money 80%. 80% of the time we find a cheap bond that pays a capital gain. So we're actually, it's a very inefficient market. It's not, we don't see a proliferation of algorithmic traders or quantitative traders. It's a very archaic market, and it's very replete with pricing discrepancies that make buying and selling bonds quite lucrative.
And that's where you sort of get that extra margin
Correct.
in that inefficient market.
Correct.
Whereas the stock markets is like this, so many high frequency traders out there.
You might as well just allocate to an ETF.
Exactly. And so that sounds like a good place to park sort of some short-term capital that you need sort of liquidity on, whether that's rainy day sort of account, because I think a lot of people put money into the bank account for a rainy day. That's something the Barefoot Investor advocates for. You got to have a rainy day account and just put it in cash, put it in savings, but you could actually be putting into the bond market in something which is very, very low risk.
So I think the key to understand is that like portfolios and investments are a risk continuum. So the riskier stuff can disappear in value very, very quickly. Even with cash, there's risk because ultimately, in theory, a bank could default on a cash deposit. And it has happened, I think, on a few occasions in the history of this country. And yes, bonds are at the very, very low risk of the spectrum. We have some bonds, they're called secured covered bonds, issued by banks, which are technically safer than bank deposits. And then we have other bonds that are riskier than bank deposits, but they are all, I think, of relatively comparable risk profiles. If you were to juxtapose or contextualize them against something like equities or property, where you can have massive losses. Now, obviously, there are parts of the bond market that are very risky. We talked about this before.
Junk bonds,
Junk bonds, Virgin Airline bonds, Credit Suisse hybrids. So there are debt securities that can also disappear in value. But that's not what we focus on. We focus on investing in bonds issued by the safest banks and safest governments in the world, where there are basically de minimis default risks. And I think as a rainy day proposition, I think what you're saying is, there's not just one rainy day solution, which is cash. There are government bonds, there are bank bonds, and there are bonds that are safer than cash. There are bonds that are risky in cash. And does it make sense to have a diversified portfolio of these securities? For sure.
Yeah. And you run a couple of ETFs, but you also run some managed fund products as well.
Correct.
And tell us what's the best yielding one so far?
The best yielding ETF is YLDX, which is 7.1%. The best yielding managed fund is our long short opportunities fund, which is paying 7.8%. But it's very similar, A+ rated, daily liquidity. It's floating rate, not fixed rate, which means you have an interest rate profile that is risk minimized. And again, that's the yield on the portfolio. We would hope to add value to that yield. So rather than just paying out 7.8% through the trading gains, we'd hope to improve on that.
Yeah, and in terms of capital gains and
yes, correct.
Sort of so combined capital gains plus yield, what is the rough ballpark figure for?
So historically we've added in that long short strategy. Historically, we've added a few percentage points above the yield. So on top of the yield, there's been 200 or 300 basis points or 2 or 3 percentage points of extra return. So if the yield today is 7 to 8%, we would hope that if everything sort of conspired in our favor, we'd be punching out total returns after fees that are a few percentage points above that. So potentially high single digits, low double digits. But again, this is not crypto. This is not equity. This is sort of that portfolio is basically A+ rated global bank bonds. These are some of the safest assets that exist.
Exactly.
So we're not targeting 20-30% returns.
No. I mean, we're not targeting this. This is still on the low risk continuum as far as I'm concerned.
Yeah.
And I think that does make sort of relative attractive in terms of the low volatility and something that's liquid that you could park some money in for a short period of time.
Correct.
For instance, in my situation, we've just moved out of our owner occupied and we're renting in the interim, and we're at the stage where we've got so much money sitting in the offset. Rather than put it in the offset and offsetting 5% interest, I could have that potentially somewhere else.
It depends on the relative
my risk
expected
appetite.
returns.
My risk appetite as well. But
but
that's
if you've got
a possibility.
if you've got a low interest rate, on your home loan, and you can get total returns of 7 to 10%, then that might be an attractive opportunity that you want to capitalize on.
Yeah, and I think for those that are rent vesting and have nowhere to put their cash, that could be a very attractive place.
Great.
And of course, it's not financial advice. This is just general advice, and go speak to your financial advisor or
100%.
Read the PDS.
Yep.
Yeah. Beautiful. Thank you again for coming on our show.
Thank you, Dave, for having me.
I'm sure we'll cross paths in the future.
Appreciate it. Thank you.
Thank you. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.